Good news, interest rates stayed the same for now, but is it over? That's what I want to talk about today because what's coming out right now is questioning a lot of people's beliefs. Now, I know that there's a lot of real estate investors that think rates are going to come back down. Even people in the stock market are saying the same thing, but are they actually going to come down or not?
Tell me!
So I want to share some words from the Fed presidents from out of their own mouths. And just so you know, a lot of times they usually lie. But I want to show something really quickly because what they're talking about right now, and especially what they're projecting for the future, isn't what many people have been hoping for. And this can be dangerous for you. It doesn't matter if you're in the stock market or if you're in the real estate market. All right, so this is an article called that Fed's Bowman signals she favors more than one further rate hike. Now, Bowman, they're referring to the Fed Reserve Governor Michelle Bowman, saying that she wants to see more rate hikes come up in the future. She's not alone. They've been saying that in 2023, they're expecting one more rate hike, at least. That's probably going to be true. I think in the next meeting, you're going to see that, where it's going to go up probably another 0.25%. Now, many people have been saying, come on, stop this. This is ridiculous. You're hurting banks. Like, this is why banks started to fail a little bit, because some of them weren't ready for those huge rush of interest rates. But there's also real estate investors not ready for it. And there's also people in the stock market not ready for it, which affect tech companies specifically and other companies that use credit, essentially, right? Whenever you see this happening, in fact, even for your own self, your credit card balances now are getting charged on average 20% interest on your credit card right now. That's an average, guys. That's the highest it's been in 40 years. That's huge. Not to mention mortgage rates are up more, and they're even talking about going up to 8%. Guys, now I know if you would have gone back and asked the generation ago, say, hey, what do you think of 8%? Especially if we went back to the 1990s, they'd say, oh, not bad. That's about what we were expecting. We're paying 9%.
Not bad, not bad.
You go back to the 80s, they're paying into the teens percent for the mortgage. But this is different. We just a year and a half ago had dirt cheap interest rates, mortgage rates. People were getting them for below 3%. Now you're buying rates at 7+% right now. Here's the real question. What do the feds really want?
What do you want? What do you want?
It's not that simple.
What do you want?
Now, I want to read this here in the article. If you go down further, this is the big thing they say. I continue to expect that further rate hikes will likely be needed to return inflation to 2% in a timely manner, Bowman said Friday, using the plural hikes to describe her rate expectations. She noted that Fed officials expect inflation to stay above 2% until at least the end of 2025, which is the median forecast of their projections. That's end of 2025, guys. That's another 2 years out. Remember, their whole goal is to get inflation down to the government reported 2%, which is not really 2%. We know it's higher than that, but they're trying to get it back down to that 2%, which is still pretty decent inflation. That is their goal. Now, they've been raising rates. They've been raising them up. But even though they've been raising rates and we've seen them go up a lot, and it's making our pockets a little bit leaner lately, the problem is that it hasn't quite worked. So this is what she says further. This, along with my own expectation that progress on inflation is likely to be slow given the current level of monetary policy restraint, suggests that further policy tightening will be needed to bring inflation down in a sustainable and timely manner, she said. She also says here, and this is where it gets a little bit interesting. It's just a small piece of paragraph. While there has been considerable progress in lowering inflation, higher energy costs present a risk again for achieving that 2% inflation goal. Then she says this, I see continued risk that energy prices could rise further and reverse some of the progress we have seen on inflation in recent months. Here's the quote I want to get to, especially just to kind of catch you up on what she just said there. What she's saying is oil costs, and this is also natural gas costs going into the wintertime, those costs are going to rise and start hurting us more. It's going to show more inflation. So even though they're trying to get it down, it seemed like it's been okay. We also didn't have rising gas prices either. We actually saw them lower for quite some time. Now, just in the last few months, they're starting to skyrocket upward. The gas prices soon follow, as well as your natural gas when you go into the wintertime. That's a big double whammy for you if you're someone who's just trying to live paycheck to paycheck right now. Now, here's what she also says. She says, despite the tightening of bank lending standards, so basically saying, despite the fact that banks have restricted lending a little bit, meaning they're not lending money out to you as much, we have not seen signs of a sharp contraction in credit that would significantly slow economic activity. She says, though bank loan balance growth has slowed, the ongoing strong balance sheets of household and businesses combined with the growing importance of non-banks as source of credit, yada, 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 basically suggests that the effects of monetary policy on bank lending may have smaller effects on the economy than in the past. So what is she saying? She's saying, despite rising interest rates, people are still borrowing money and the banks are still willing to lend the money. What they have been trying to do is that they raise rates. People don't want to lend money, don't want to borrow money, right? Because you don't want to pay more for that money. But people are still borrowing money because sadly enough, Americans got used and accustomed to all this extra money being around. And so they've already started to notice bank balances going down, but yet people are still spending money, even if it means they have to do it on credit. Well, if it's not slowing down spending, that means your inflation doesn't slow down, because as long as people are spending money, they can keep rising prices on you. And that's just normal. I mean, because the truth is that as your costs go up, you also want to raise at work. So you're driving up inflation too, because you want more money at work too. And that's just driving everything up. And so as a result, even though they raise interest rates, usually slow down the economy, it hasn't worked. The economy's been just chugging right along because you still have credit that you can spend. Even if you don't have the cash, you can go to credit. This is a problem, because what they're trying to do is essentially get you to the point where you're going broke, right? Where the average American gets hurt, where they can't get any more money. They can't get any more credit. They can't spend more money. So it slows down the price increases, because now stores aren't making as much money. And then they know their job is starting to work. This means that they have to hurt you a little bit more. This means if costs like this keep going up, this means that they keep raising rates. Some of these businesses will lay off more employees, which will also help them get their goal. So they're pretty much not going to stop until really the average American, not the wealthy, not the banks as much, but the average American gets hurt. You have to get to the point where either you can't spend any more money, or two, you get laid off at work, or both. That's what's really happening. This is a big, big problem. Here's the thing. What are you going to do about it, right? What can you do? The biggest thing is right now is pay off those credit cards. Get rid of them. I know I talk about passive income and investing in real estate. I'm telling you, if you've got credit card balances, pay them off. They're going to keep going up. Now, while you're doing that, one big bonus hack that you can do as well is you can actually go to your credit card company and ask them to lower your rate for you. Ask them to do that so you can pay it off faster. Right now, 75% of people are told, yes, they will lower the rate. And on average, when they lower it, it's 6%. That's a big deal. So I would put more focus to trying to pay that off. Call up those credit card companies, lower the credit. Don't have to cancel the credit cards unless you're having a spending problem, then maybe you need it. But really using this as your opportunity to actually get your cash flow under control. Do that. And then, of course, you've got money to invest. I'm just telling you, the stock market is about to get hurt badly. They're not going to stop raising rates until it kills the stock market. It kills a lot of other things in the economy. It's going to hurt. This is also going to hurt some aspects of real estate. Not all of it. That's the good news. If you're looking to do real estate, there are still great ways to do real estate, even where you become the lender, like you become the bank and you get paid the interest. Many people don't realize you can actually do that. You can actually loan money to investors, let them make the money, and then you get paid interest like you're the bank. But you get paid much better returns than you would try to gamble in the stock market, where it could possibly drop and lose money. Again, I just tell you this, is that you can make a lot more money in the real estate game if you know what you're doing. But for my friends that are in real estate, the ones that are saying, oh, they're going to lower rates, and I'm going to literally hope and bank on it. Don't do this. Do not expect rates to go down. Let me show you this. At the very top here, you'll see the dot plot, right? The Fed's dot plot. What this is of all the bank presidents that are out there, they all vote based on what they think the projections are. They don't say what their names are. They just put the dots on there saying, here's the number of times. So we can already see in 2023, they all pretty much expected to go up over the 5.5%. Really, it's the 5.5 to 5.75. But for you, what that means is prime rate, which is usually the better rate that banks give you, would be 3% more than that. It means you're going to get like an 8.75% just for its typical loan. All right. So they want to raise that up just another 0.25%. But then in 2024, there's a few of them that think it should go higher. It should go higher in 2024 than even 2023. For the most part, though, the average is just a little bit less than where we are right now, just barely. So they're pretty much trying to keep rates high, well above 5%. It's now at, like I said, about 5.25 to 5.5. It's at that point, they want to still keep it above 5% in 2024. Finally, in 2025, they're starting to project that maybe they'll lower it down to around 4% on average. And then finally, by 2026, guys, 3 years later, they think it might finally lower it to the range of right around, just about 3%. 3%, by the way, just so you know, 3% is kind of like the par, right? The par rate. It's the rate that doesn't really help the economy, doesn't hurt the economy. They're finally thinking that it'll be 2026 before they can finally say, okay, we can lower it a little bit more. 3% is not low. Before, if you just remember, just really a year and a half ago, it was at zero. It was really like between 0 and 0.25%. And they're still expecting it to be there. And even long term, they want to finally bring it down to like 2.5% average is where they're thinking. So still, they're not planning to bring this down anytime soon. So if you're literally hoping from the lower rates, or maybe you're hoping to wait on that house to buy until rates come down, that's probably not going to happen for at least a few years, guys. So if you're waiting for this, and if inflation does keep going up like they're worried it already has been doing, you could be waiting for a long, long time before you get that opportunity. So my warning to you is don't bet that these rates are going to go down anytime soon. That means your stocks are in trouble. And that means if you've got real estate in certain places where you're expecting variable interest rates, maybe you don't have a fixed interest rate, that's bad. If you got a home equity line of credit, that could be bad. You want fixed low interest rates, as low as you can get them. Don't go for like the 10, 15-year mortgages. Still go for the 30-year to make sure there's a lower payment, because I think that's going to hurt us, not just on the interest rate side, it's going to hurt us on the pocketbook side because prices are going to keep going up. That is my warning. That is the thing that you need to be aware of, is that they don't even think inflation is under control, which means it's not over yet. And something worse could be coming down the pipe. Be aware, guys. Be ready. And that's my advice to you. If you want to follow for more, subscribe to our channel, the Money Ripples channel. And hey, leave us your comments. What do you think? Do you think they're going to finally lower rates, or do you think this is going to go on for a while? Go ahead and leave that in the comments below.